Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Over and over and over again, we see it all the time. People coming in and talking to us on the phone, they build their wealth in one area, whether it's their 401k, their business, real estate, whatever it is, typically one thing. And now they're at a point in their life where they're wanting to change it to be able to diversify and to give them a forever portfolio. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about the forever portfolio. And AAA, you are correct. Typically, investors, entrepreneurs, business owners, they build their wealth very concentrated. It's in their company stock, and the company goes public, and now they've got this huge amount of money in one company. They've just been packing all the money they could away into a 401k or into a real estate rental property or into just their own business, and it doesn't go public, but they sell it, right?
Mm-hmm. Mm-hmm.
And now they're looking for some way. They've already built their wealth.
Mm-hmm.
They're looking to protect it and to give them peace of mind, to give them a paycheck, right? To give them some kind of income.
Mm-hmm. Yeah. And you know, that's what today's show is all about. And this whole program, Financial Strategies with Andrew Daniel Agemy, is about for people who have already built their wealth. This is not for people who are trying to become millionaires in the next year or two or whatever, or, grow their money. This is not for people just starting out, putting money away. This is for people who have built their wealth. And that's why we're talking about this, right? And we do this, we see this over and over again, how people build it. And then, it's kind of like what I talk about, the retirement mountain. You get up the retirement mountain one way, right? 2-seater sports car, really fun and exciting. But then across the top of that mountain, do you really want a 2-seater sports car? Do you want all-wheel drive vehicle, SUV driven by a driver that's been there before, right? You got to change what you do in order to make sure that you don't run out of money. And that's why we're calling it a show, a forever portfolio, because, typically people put money in the market, but that's not a forever portfolio. That's good for growing your money. If you're just going into the stock market, whatever, right? Or your business or any of these one things, it's good. You grow your money one way, but when it's time to receive a paycheck in retirement, your own pension, make your own pension, right? Then it's a different deal, and it's time to change up and diversify, because we all understand the idea of having all your eggs in one basket is not good for the long haul.
Yeah. Let me try to say that a little differently. To grow the portfolio, you want concentrated risk, not necessarily markets, because markets go up and down and sideways, and you may or may not make money, but it's typically concentrated. But once you have wealth, do you want that anxiety of being concentrated? Some of you do, most of you don't, because we talk to you every day.
Right.
You don't want that. You want to remove it from the speculation phase to a pay me. And the industry calls investments things that we do not consider investment. The definition of investment is it needs to pay you, right? But people in the industry take your money and they put it into something, and they hope that it goes from $8 a share to $10 a share. They're okay if it goes from $8 a share to $2 a share, as long as some point in time it goes up to $11 a share. That's crazy to us, and that's crazy to people who have already accumulated wealth.
That's right.
We want something that you can go from, $800 a bond to $1,000 a bond and collect 6% in the meantime, right?
Right. And that's a beautiful thing. And that's what gives you a true investment, right? But that speculative kind of thing, that's good for the long haul. Like I have a friend that, 1971 bought a brand new Dodge Challenger Hemi with a 4-speed for about $4,000, $5,000, that in 2022 sold it for over $1 million. So, that's a great thing over that 50-year period of time, right? But it was speculative.
But think about how many hundreds of people bought a car in that same period of time that lost out. Like Like
Right.
that's the speculation. Speculation doesn't mean you always win. You're
Right.
thinking one situation where a guy won,
Right.
but there's
Right.
hundreds, if not thousands, if not millions that
Right.
lost out doing that same thing because they didn't pick the right car, right?
Kind of like the lottery, right? The lottery is
or
speculative.
investment portfolios you and I were talking about earlier, where someone did very good on particular investments that were speculative, but the whole portfolio wasn't higher in 3 years.
Right.
Like investment returns that people could only dream about on certain investments, but it still didn't outperform just a basic income with, some of these monetary hedges that we use in there.
You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is the forever portfolio. And we're talking about true diversification and how that all works and why it's important for people. And we have a paper to go along with today's show that we'd love to be able to put in your hands. It's called Bonds versus Bond Funds. So many times people don't understand. They understand that bonds are important, that bonds are safer than stock from that standpoint, but they don't understand the difference between bonds, individual bonds, and bond funds and how they work. We'd love to put this paper in your hand. It's a couple pages long. It's not long, but give you a lot of good information that will help you know what the person next to you doesn't know. And you can have that by calling 800-725-7616 for your free copy. Ask for it by name, Bond Funds, 800-725-7616. Daniel, that reminds me, when what conversation I had yesterday where, I was talking with a person was not our client and he was saying, oh yeah, well, my portfolio, I've done about 6.5% return every year for the past 10 years. So it's not the greatest, but it's not too bad either. And I said, well, in my mind, that's a lot. That is bad. I mean, compared to, we got clients that are doing that kind of return with a customized portfolio and less than half the risk that you're putting in. So, just because you're risking doesn't mean you're going to get the right reward. And, that is the big concern, especially as people go into retirement, because they need different investments to do, because they're doing things differently. As they go into retirement, now they're going to be starting to take money out or using the money as opposed to all those years of putting the money in. And if they're not careful, they can actually make themselves run out of money. So you need a portfolio that's going to be forever.
Right. So we're talking about diversification. We debated calling this show old school diversification, right? Or old school investment diversification, because the art of diversification is forgotten. We went from a diversified, protect what I have, to a simplicity model, right? And that's where passive indexing came in. That's where the indexation of everything came in. And what ends up happening is you lose some of the benefits of diversification, because we went for simplicity, or not us, but I'm saying the industry as a whole.
Right.
The industry as a whole went to simplicity. So instead of buying a bond where you have two very important things, you have a guarantee return of principal. The company has a contract that says on this date, we're going to give you your money back.
Right.
And in the meantime, we're going to pay you 6%. Right?
Whatever their interest rate is.
And that's difficult. Number one, they only get paid one time. The syndicate gets paid to issue that bond, and then nobody makes money off of it, really. There's no fees. Right. So they came up with this idea. It's hard to buy a bond. It's not hard to buy a bond. It's hard to do the investment research to pick a good bond, but it's not hard to buy a bond. So instead of doing individual research to buy a corporate bond that's going to pay you 6-7%, and when you get your principal back, we'll just put a bunch of these inside of a wrapper, and now anyone can buy it with a push of a button. The difficulty is it took this asset that could be either minimally correlated or non-correlated to your other assets. And what that means is correlation means just what it sounds like. Everything does the same thing. When one thing goes up, they all go up. When one thing goes down, they all go down. They're all correlated to each other. And diversification means when something's going up, something might be flat. When something's going down, something's going up. And when you get real, what we call investments, you're getting paid no matter what's happening in the portfolio on top of that, right?
Yeah.
So the non-correlated assets are what make true diversification. So example, if we look at that bond again, right? The company says we're going to pay you 7%. We'll say 7% we'll pay you for 4 years. And at the end of 4 years, we'll give you your $100,000 back. So in year 3, that next year, you're going to get $100,000.
Yeah.
Now, let's say in year 3, year 4, markets fall apart. Well, S&P comes down 50%, 40%, 25%, whatever you choose, and you get this bond coming due, and $100,000 drops into your account. So you've been getting paid your 7% for 4 years, and now $100,000 drops into your account, and you get to choose, do I want to buy S&P at a discount? Do I want to buy another bond? Because maybe you can buy bonds at discounts now because stuff's coming down. So even though that may not be a non-correlated asset, it can work like a non-correlated asset because it turned into cash when you need cash.
Right. And this is all important because people need to have the right portfolio, need to be able to get a paycheck. It's not that you need $1 million, $2 million, and when you retire, you need a paycheck that will be able to come in from your portfolio. So, we did a show on creating massive and mega wealth, right? Or income rather for retirement. And that's what we're talking about, how to achieve that through a forever portfolio that's going to be non-correlated investments, not like, when ships on the ocean are correlated, right? When the tide goes out, they all come down. When the tide comes in, they all go up. And that's what, true diversification, when it was originally come out, was so much in cash and so much in commodities, so much in gold, so much in stock, all these different things, so much in individual bonds. But then as time has gone on, and with, the 80s with mutual funds coming on the scene, and then the new century that we're in with the ETFs, especially being so prominent, people are like, well, it's not so much individual anymore. Now it's like, so much in bond funds and so much in global mutual funds and so much in small cap mutual funds and so much in growth mutual funds. And it's all about mutual funds. And those are all correlated. They're not non-correlated. And that's what we're talking about today, non-correlated. Well, talking about that, we have a book. We are always trying to, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. In order to try to help you to know what you don't know, we have a book that we'd love to give you by our friend Jeff Small. And Jeff has written this book called Turning Financial Planning Right Side Up. And in this book, Jeff goes into the techniques and the technical end of investing and having true diversification forever portfolio. We'd love to be able to put this book in your hand. It's currently out of print, but we've got some for you here, and you can have that for free for calling us at 800-725-7616, 800-725-7616. To the next 5 first-time callers, call now. We'll be right back after this.
Important financial question. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Sources investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Agemy.
McDonald's makes hamburgers. Now, do they make the absolute best hamburger in the world? Well, usually you go to McDonald's because maybe you're in a hurry or one thing you can get from McDonald's, no matter what, is consistency. They are very consistent with things, but they don't make the best hamburger in the world. They're fast food, right? Where do you go if you want the best hamburger? That kind of place that even think about the hamburger and your mouth starts to water, right? That place that's going to make that burger exactly to the way that you want to make it. Well, you go to a boutique burger joint that makes burgers the way that you like them. And that there's nothing like that burger in the world. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about truly diversified portfolios. And AAA, what does burgers have to do with diversification?
Well, McDonald's is fast food, and then you were talking about if you want the real good stuff, you go to a boutique place that is using fresh meat and all those other kinds of things. And they may not have as many customers, and it may cost a little bit more, but whatever the case may be, you're getting the end product is a great product. Well, in the financial industry, it's kind of the same way. There's a lot of companies out there that are the fast food, in my opinion, the fast food of the financial industry. Big name companies out there where they're handling everybody. They're handling 401ks. There you can call them up. They got an 800 number. You type in finances on the computer, and boom, their name comes up. Right? They're the fast food industry. It's fast food of the financial industry. Well, where do you go if you want a true forever portfolio? You go to a boutique place that specializes in forever portfolios, but that does true diversification. That gives you customized portfolios, just like you get that customized burger made the way that you like it. And that's what we're talking about, is that and that financial strategies, we're talking about this because this is the kind of thing we think people are deserving of, and this is what our clients enjoy.
Yeah. It's like you get a number one and number two, these cutter approaches, right? The investment strategies. You and I were talking earlier, and like we're just like kind of dumbfounded when we actually stopped and thought about it. Like the equity / whatever funds of funds portfolio, that if you are 25 years old and you have 20 grand, you're going to get basically the same thing, the same funds, maybe different percentages. Or if you just sold a business and you've got $10 million, they're going to put you kind of in the exact same funds. It's going to be the same thing. How does that make any sense? Right?
Right.
One guy is trying to grow wealth and one person is trying to protect wealth. How does that make sense? And it's kind of mind blowing, but it's that disease of ease. It's that simplification, right? That indexing, which just like it's easy to go to, you said, the fast food store and order a number one, number two, number three. Yeah. They might customize it a little bit. You could get pickles or no pickles, but you can't get it cooked the way you want it, right? You can't get,
fresh. You can't get fresh
ingredients.
Well, I guess,
exactly.
Whatever. Well, I guess there's a couple places that do that, but whatever. But that's the idea, right? But you want, when it comes to your financial portfolio, one that's going to be able to last the rest of your life, forever portfolio, you want it to be customized to you. And what so many people are settling for is fast food, right? And they're settling for the disease of ease, the push the button picking. They think, this is my guy. He's managing my money. No, all he's doing is pushing a button, checking a box to pick what you want. And he's getting the bulk of the 2% that you're paying, whereas the people who are actually managing their money are getting less than that. And whereas, you could be paying less than 1% for a customized portfolio. You go to some of these other fast food places and they might have cheaper portfolios than the guy that's charging 2% all in. But, it's a crazy thing. But
what do you care? If you've got $1 million, if you get $2 million, what do you care? What do you care? If you pay more, you're probably paying like the mutual funds. Between what you're paying mutual funds and the advisor, you're probably paying 1.5%, maybe 2%. You got $1 million. That's egregious. You could get the customized portfolio for probably 1%. And even if it was cheaper, if you were paying 75 basis points, right?
Yeah.
For mutual funds and 1%, who cares? It's you're paying 25 basis point more for custom. You're going to earn more money. You're going to have less volatility. What do you care? We talk to people all the time who have money sitting in the bank, $200,000, $300,000, $400,000 in the bank. They're not our clients. They got this money sitting in the bank and they don't know. No one's told them that can be generating for them, $10,000, $20,000 a year with lower risk than the bank by moving into something that's called a money market fund, right? That buys treasuries, or moving it into treasury bonds, and they can get 5% on that now. It's insane to me how somebody would worry about a couple basis points on one side, but they don't want to earn $20,000 for the
On the other side.
200.
I agree,
it's
Daniel.
ridiculous.
It's crazy. Well, you're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is the forever portfolio, how you can diversify your portfolio to be able to last forever and not run out of money and be able to give you what you need in retirement. Well, we have a paper as we try to educate people to know what they don't know called Bonds versus Bond Funds. This paper is what we're talking about today. It's the people diversifying. They go into bond funds but thinking that they're making their portfolio a little bit safer. Well, they're are they really? Well, bonds, going into individual bond funds is a lot safer thing. This will explain that in detail, be able to help you understand it in an effective manner. You can have it for free by calling us at 800-725-7616, Bonds versus Bond Funds, 800-725-7616. Ask for it by name. Daniel, when we're talking about these things, and people not making the interest on money that they could be making. I talked to a person with $500,000 not too long ago, was just sitting in the bank getting nothing. And I was like, are you crazy? You could be making $25,000 a year on this money. And they kind of, shrugged it off. But I was glad to hear that later on they did end up putting in something, making a little bit more. But, there's a difference between banks and brokerages too. I mean, when we're talking about true diversification for whatever portfolio, it's just not the investments you put it in. There's the tax strategies, there's the performance strategies involved or the investment strategies. But then there's also, where you're having that money, right? And people who have money at the bank, they think it's safe, but it's actually not. When they give it to the bank, they're actually giving it to the bank when they think that they're not, right? As opposed to brokerage accounts, that it's truly their money, right? An account that can be invested in, right?
Yeah. Like I've heard so many times people will say, well, I like that I can walk down and talk to the bank. So the bank is not your friend.
Right.
The reason we think banks are safe is because there's something called FDIC insurance. And basically that's banks pay into this fund that the government holds. And they say, if the bank fails, we will back up $250,000.
Right.
So what that allows the banks to do is take on excessive leverage. Okay. And so banks like JP Morgan or Wells Fargo or Bank of America, these big ones, what they're doing is they're taking your money and they're leveraging it up. They're doing aggressive things like a hedge fund would do. And how much are they paying you? Nothing. Why? How can they do that? Because people feel it's safe, right?
Yeah, right.
So, like the derivatives are like in the quadrillions of dollars that JP Morgan has. So, do you understand the risk behind that, right? If they make that mistake, but they're too big to fail, so it's okay. Now, would you like to go with too big to fail and it's okay and get paid nothing for that? Or would you like to take your hard-earned capital and put it into something where we call it sacred, where the company is holding your money for you. You're not loaning it to them. Okay. And so what I mean by that is when you put money in the bank, it's legally no longer your money. It's the bank's money. They can do whatever they like with it and they owe you the money. And we all know what happens when someone owes us money, right? They might not pay it back. They've recently changed banking rules to do what's called a bail-in, which has happened in Europe a few times over the last decade, where instead of a bail-out where the government steps in and gives you the money back, it's a bail-in. They take the depositor's money over the FDIC limit and they bail the bank out with your money, and they can legally do that. So if you have over $250,000, you need to look at alternatives or at least break it up into different banks, right?
Right.
You're talking about brokerage accounts. You could take your money, put it into a brokerage account and either buy US Treasuries. If you buy the notes or the bills, you could probably get around 5%. And if you buy like a Treasury money market account, you can get right around 5%. And now the brokerage account is holding your money for you. It's a custody rule. They have to hold that money for you. They're not leveraging it up. They're not buying derivatives with it. They're not doing anything like that. It's your money. They're just holding it from you. And that's the difference. We all think that with a bank, they're holding your money. They're not. When you put it in the bank, it's the bank's money, and they have an IOU to give you the money back.
Far less than a fiduciary arrangement on that. And, and of course there's mutual banks, there's credit unions where, the depositors are the ones that own the bank. So ideally the bank, the credit union is working in the depositor's best interest, but those are not around like they used to be. They're still around here and there. Credit unions are kind of popping up all over, but mutual banks are not around like they used to be. And those are going to be a far better place for you than the big boys from that standpoint, because, when you give the bank the money, if you read the contract, it's going to be able to say that, basically it's their money and they owe it to you. But
Right.
if they don't have the money, guess what happens? We all know what happens when people owe you money and they don't have any money. Well, that's the same thing that can happen with a bank. And people don't know what people don't know. Well, you're listening to Financial Strategies with Daniel Agemy. Today's topic is the forever portfolio. And we're trying to help you to understand how you can have a forever portfolio and not be able to run out of money once you hit, even though 5 or 10 years before retirement, you should be looking at transitioning to a forever portfolio. Just Small wrote a book, Turning Financial Planning Right Side Up. This book talks about diversifying your portfolio, having a forever portfolio. And we love to put this out of print book into your hand for free by calling us at 800-725-7616. 800-725-7616 for your free copy to the next 5 first-time callers, 800-725-7616. Call now.
Time for some tough questions for these financial advisors. What makes retirement income source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love.
We gotta talk to these guys. We're done here.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
Recently, I was in Florida, and when I travel, I like to rent some nice cars and take cars. And whenever I go back and take the car back to the rental place in the airports, they always have these kind of like gates, right, where you drive over. They got like fingers, they got like claws. As long as you take in the car in, you're good to go, right? You're going in one direction, it works really well, but try to back up over those suckers, man. You're going to pop all those tires and it's not going to work well in the other direction at all. It's a completely different scenario. It's kind of like tube of toothpaste, right? And, it comes out real easy, but try to get that sucker back in that tube. It's not going. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about the forever portfolio. AAA, those things can be a little freaky. Those things can be a little freaky. Even when you drive over them knowing you're going the right way, you're like,
it's scary. Right. But the point behind it is that, when people are building their portfolios, they build them one way that works really well. Right. But when they start, wanting to live off their money in retirement and use their money to create income for them, you can't invest it the same way. You got to go the other direction, so to speak, we'll call it, right? From an accumulation mindset and strategy into diversifying into a distribution strategy, one that you can actually distribute the money because it works differently, and how your investments need to be different because, you could actually run out of money. If you keep your money the way you do in a distribution and, you have to withdraw it, if it's in the same way that it's during the accumulation stage of life. And if that's the case, that's how people run out of money. And that's the greatest mistake that retirees make with their money, is not converting money from a distribution strategy, accumulation strategy, into a distribution strategy at the right time. And 5 to 10 years before retirement, that's ideal. But whenever, today is the first day of the rest of your retirement, if you're 5 or 10 years or in retirement, right? So that's important that's what we're talking about today, is diversifying, true diversification. And it's not just on the investments.
Yeah. And so when we're talking about a forever portfolio, when you go back and look at asset classes and you go back and you look at how what would have worked over 100, 200 years. And we're kind of biased in the US because the US markets have done so good and people say markets always go up. Well, if you look at some other countries like Germany and places like that, they've had their entire stock markets go to zero, be wiped out. So we are not interested in just putting money, just throwing money at the wind, saying this is always good. Just buy US equity, just do this. Okay. We're not trying to compare S&P to income. We're not trying to do any of these things. What we're trying to do is give people an alternative, a way to protect their hard-earned money and to generate a nice return on top of that. So when we look at history and we look at what has worked, typically you could break it down into 5 buckets, right? You have cash for 20%. You've got real estate for 20%. You've got stocks or equities for 20%. You've got gold or gold-like investments for 20%. And then you've got bonds. And what ends up happening is if you rebalance those into 20% into each thing, if equities are down because it's a 90% correction like NASDAQ did in the 2000s, right? That means some of the money is coming out of cash because it didn't go down and going into equities, or gold went up then too. So that's going in the equity bucket. Then when NASDAQ is going to the sky over the next 20 years, right? Money would have come out of that and gone into gold because gold came down, and now gold's going back up while NASDAQ has kind of been flat, right?
Right.
So that's how that works. We do it a little bit differently because we're doing this active. This is meant to be kind of, you're barely ever changing it, right? These 5 buckets. We're doing it more actively, and we're doing it for people who typically want some income. So we are more focused on income, and we mix in some things in with these individual securities that can really pay out some high numbers in income. We got into this a little bit in either last week or week before on our radio show, right? We were talking about generating massive income, and we believe in generating massive income. And so we didn't get into all of the things, and we know some people may have some questions on some of these things. So we're going to go into a little bit more, some of the things, how you can build the truly diversified portfolio.
Right. Excellent. And, when Daniel's talking about income, people say, well, I don't need income. I'm working, or I got enough income from my pension and Social Security and retirement. I don't need any income. Well, if you don't need the income, that's okay. You can reinvest it, and you'll grow your assets the old-fashioned way, organically through compounding, as opposed from $10 a share, $11 a share, $12 a share. Because the problem with that is it can go the other direction. But before we get into that, Daniel, I would like you to pick up after I give this identification. You're listening to Financial Strategies with Andrew and Daniel Agemy. This father and son team is here to be able to help educate you, to be able to understand those things that you don't know. You're busy doing life, and that's a great and wonderful thing. That what we want to be able to help you, to be able to educate you, and we educate thousands of people every year to be able to be a better steward of their money. Today we have a paper that goes along with today's show that we'd like to give you to be able to help you understand as you're looking 5-10 years toward retirement, or maybe you're in retirement. It's called the RRR. Ask for it by name, RRR. It's the Retirement Risk Report. Will you outlive your money? Well, this report, it's only about 5 pages long or so, and it's going to be able to help you understand how to get a retirement risk report, what that retirement risk report would do, and how you can know if you can retire, when you can retire, and how much you need to be able to retire, to do the things you want to do, not just the things that you need to do. And so we'd love to be able to put this in your hand by calling us at 800-725-7616, 800-725-7616. Ask for it by name, RRR. Okay. And we're back. And Daniel, there's a variety of instruments, of vehicles, financial investment vehicles that we can use to be able to help us have a forever portfolio. And, you're dealing with these day in, day out, analyzing them. Where do we start?
Well, I want to go back to what you said before we went to the break, which I think is something people miss all the time. And this is super key. So People might say, well, I don't need income. I have a pension. I have Social Security. I don't need income. If your boss offered you a raise at work, would you ever say I have enough income? It's ridiculous to say that. Andrew, you're an entrepreneur. If you have too much income coming in, what do? You can spend it. You can reinvest it. You can buy another business, right? There's not such thing as too much income. So don't think of income as you have to spend it. If you have too much income and you're swimming in income and it's too much, you go buy another business. And in this case, when we're talking about another business, we're talking about buying more things that pay you more money. If you're in real estate and you have too much real estate income coming in, what do? You go buy more real estate for two reasons. One, because you want more investments and you want more diversification and you want more income. And the other is because you get a tax break for doing that, right? Because you get more depreciation.
Right.
So there's not such thing as too much income. You don't have to spend it. You can reinvest it and grow it organically. So when we're talking about these income things, don't think that you have to spend it if you don't need more income. Don't think you have to take taxes on it, because there are ways that you can make sure you don't have to pay taxes on it. There's a lot of cool things you could do. We're not getting into that today.
That's another diversification. Tax diversification is another topic. Yeah.
But it's ridiculous to think that too much income or you don't need more income, just like your employer, you're not going to say, I make too much money. Can you lower my pay? You'll find things to do with it, right?
Yeah.
So let's talk about, we talked about brokerage. We talked about brokerage, and now is an amazing time. A lot of people don't know this. The Federal Reserve has hiked rates, and they've given you this amazing opportunity where you can invest in the U.S. government's short-term, debt. Treasury notes, treasury bills, you can earn about 5%. So there's not really anything safer than that on a short-term basis, because the U.S. government has a money printer and they will pay you your money back. They can create all the money they want. So that's a pretty amazing thing. And that's why everyone I'm talking to, if you got a couple $300 million in the bank, whatever, put it to work. Yeah. And some people are like, it's too much work. I got $100,000. I don't really care about earning $5,000 a year. Well, I don't know what to say to you. There's kids in Africa that could use that money. There's kids in the US starving that could use that money. There's charities you could donate that to. So if you don't want to, at least put it to work and help somebody else that could use it. Right.
And, it's an amazing thing and these securities Daniel's talking about, U.S. government securities are in the financial industry are seen as basically the safest thing that there is, safer than the bank. So, that's what we're talking about, giving you safe money, giving you a higher rate of return than the bank, right? Safer than the bank, higher rate of return than the bank. But the good news is paying 5%-ish right now. The bad news is it's paying 5%-ish. Right now. What I mean by that is, for the long run, 5% is not a good number. For the short term, that's a very good number. But for the over the future, and you could cut off your nose to spite your face by buying into like a CD, a 5% CD for 5 years. Well, that's going to give you 5% for 5 years. That's a beautiful thing. But what happens at the end of 5 years? If interest rates are below 5%, now you got a problem. You just shot yourself in the foot. But if you take that money today and you invest it for 10 years and whatnot, get you to income out of it, we can put you in a much better situation. You can have a much better forever portfolio from that standpoint.
Yeah. And that works in the portfolio for a piece, because we talked about earlier, it might come due at a time when other things are down and things like that. So it works. But if you just take all your money, put it in a 5 or 10 year CD, the difficulty is governments are creating more than 5% of the money supply each year. So you're actually losing money. So it works in the diversified portfolio. It doesn't work as your only investment. Right.
Exactly. Daniel, this show is going by in my mind. And it's time for us to take another break. Can you believe it? Well, you'll want to join us when we come back from break, because we're going to be going through those different kinds of investment vehicles to use to be able to have a forever portfolio. You won't want to miss it. But in the meantime, we have a paper that we'd like to give you to be able to help you. We're giving away the paper, our retirement risk report, but we also have a book that we'd like to give you, Just Smalls, Turning Financial Planning Right Side Up. And it's a different way, the right way of looking at financial planning and retirement planning and strategies to be able to help you to be able to diversify, to have that forever portfolio. Jeff explains how you can have that book for free by calling us at 800-725-7616. For the first 5 first-time callers, 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
Jim and Sally were our clients of ours, and several years ago when we were looking at their portfolio, trying to enhance it, make things better, they had some extra money in the bank that they wanted to know what to do with. And we recognized that, there's a situation that's a little bit on the speculation side, but the $30,000 that they invested in it was less than 1% of their total, what was it, like maybe 0.1%, or if even that, of their total portfolio. So they said, okay, well, let's see what we can do. And we knew that at some point this was going to turn around, it was going to make money for them. But we didn't know when. Well, that was about 2.5 years ago, give or take. And that $30,000 is now worth $60,000. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about the forever portfolio, and AAA. That's what we call a monetary hedge, right?
Okay.
Before we went into the break, we were talking about how you could put all your money in a CD and probably be thrilled to get 5%. But depending on your age and depending on your goals, you need to be careful, because governments are creating money at a greater rate than 5%. So if you're only earning 5%, you're actually losing money. And that's why you and I talk about all the time, cash is the slowest, most guaranteed way of losing money, right? If we look back to when the Federal Reserve was created, you've lost 99%, 98, 99% of your purchasing power. So we think cash is an important tool. We like income better, which creates tons of cash. You don't have to have as much cash. But we think cash is an important tool for opportunities. But we do it a lot different than most people. We don't have cash typically. We use other things where you have cash available, but it's actually earning you something. Right. And we already talked about from these buckets. We talked about, the 2020 portfolio.
Right.
Yeah. And cash was one of those. So I think we got that covered very well.
Right. And some of these we went through in the show on creating massive income for retirement too. So we're not going to do those, CDs and annuities and bonds, right? And so we're going to get into some of those other things we didn't really get the chance to go into too much on that show.
Right. And typically we don't have 20% cash because our income on our portfolio is so huge that there's always so much cash coming in. Cash is not as big of a concern. Or there may be alternatives that could get it up to 20% too. But the next one, let's go into the gold bucket or the monetary hedge bucket. And the monetary hedge is something that's going to give you a multiple on money printing. And so this you could call speculation. This you could call insurance. It's insurance for a government, a governmental error or a policy error, right? Mm-hmm. Something like Rome. Rome printed the Empire of Rome eventually printed their money into nothing. They debased the currency so much that the soldiers wouldn't show up to protect the country because they didn't want the money anymore. So that's where you get one. That's the story you started with this session with, where they put this money into an investment, a monetary hedge, right? Where they looked at the 30,000 as a premium.
Not
they
a
lost
stock.
it all.
not a stock in
not a
the
stock.
stock market.
Right.
Monetary hedge.
It's
Right.
a monetary hedge where they were okay with the 30,000 being a premium, where if we were completely wrong and the government got fiscally responsible and stopped printing money and it went to zero, they were okay with that. But if things continued the way they were, we thought that they could do somewhere between 100% and maybe, 1,000% over a long period of time.
Right.
And so far it's been the 100.
Right. We're still in it because we still believe that to be true.
Because it's insurance. You don't get rid of it, right? You don't get rid of insurance.
Right.
So things that fit in that bucket, depending on people, something like gold. Gold has been a great monetary hedge. Not so much in the last, call it 20, 30 years, but if we look back 100 years, it's been an amazing monetary hedge. And so that's something that we use for certain people who are not interested in some of these other ones. Another one we like is royalty and streaming companies. And we've done a bunch of shows on these, so I don't know if we need to get into these, but it's basically a leveraged play on gold. So if gold does 20%, these things might do, 100%, right? It's a leveraged play on that. It's lower risk for the monetary hedge than, say, a stock typically, but it's higher risk than just buying gold and holding gold, in your safe, right?
Right.
And then for those aggressive people, a great monetary hedge is Bitcoin, right?
Right.
And now BlackRock is finally agreeing with us. Fidelity is finally coming out and agreeing with us. We've been talking about this for a long time.
That's right.
And now you can go buy an ETF actually that holds this, and you don't need a big percentage. You don't need to put all your money in. We're not trying to 10x your money. We're not trying to 100x your money. We're not trying to make you rich. We're trying to protect you from different situations, right? And so you don't need a big percentage. A 3% position of your portfolio is like a 3% premium for an insurance policy. And if that thing does what we think it could do, that could turn into a 30% position. And if it doesn't, you're going to be happy because that means the government got fiscally responsible and all your other stuff did well.
Yeah. You're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is the forever portfolio, how not to run out of money, how to have something that's going to be vibrant and creating mega income for you. We have a paper that goes along with today's show that's going to help you a lot. If you're 5 years, 10 years before retirement or in retirement, this is going to be good. It's called the Retirement Risk Report. It's going to be able to help you to be able to understand at what risk are you at retirement? How much do you need? Will you outlive your money? When can you retire? At what risk, is your money at the risk that you think it should be at, or is it at a higher risk than what you say it should be at? All these kinds of things. But this paper is going to educate you and be able to have how to understand that better. And you can have it by calling 800-725-7616 for your free copy. Ask for it by name, RRR, Retirement Risk Report. Call now, 800-725-7616. Daniel, we just have a few minutes left, but let's
Triple A, we've been giving that paper away on, mutual funds and ETFs, right?
Right.
And when we look at passive flows in markets, passive flows have controlled markets. So for example, when you put money into your 401k, money's going into Apple, right? Money's going into Microsoft. So there's these the Magnificent Seven, they call it, which is 30% of the S&P. So people buy the S&P 500 and think they're getting 500 stocks. And they are, but 30% is in 7 stocks. And the thing that's driving those up is a passive flow, money coming in. It's the same thing with a bond ETF or a bond mutual fund. The way that a lot of these are constructed is when one does better, which means it's going up above par, more money has to go into it, which makes it more risky.
Yeah.
So you and I try to avoid these things as much as possible. We like buying individual positions, individual companies, individual businesses. We don't look at an equity ETF as a way to participate in monetary inflation because there's too much unknowns involved with that. And you
Right.
need too much of your portfolio in that, which takes on more risk than you and I like, and our clients like.
Right.
So when we look at the equity portion of this portfolio, we typically look at things that are paying us. Just like if you were buying a business, you would look at the cash flows of the business. Or if you were buying real estate, you would look at what investment real estate, you would look at what it can pay you. We look at that for the individual companies backing up the cash flows we're collecting from these equities. So instead of buying a whole bunch of equities and just hoping that more flows come into them and drive the price up, we say this company is fundamentally sound. They are going to pay us this money, and we like what their business is doing, which adds less volatility to the portfolio, more certainty to what we're getting paid. And we like to get paid, right? Our investors want to get paid.
Right.
And so when we talk about the equity slice of this portfolio, these are kinds of things, right? Individual, we like international stocks right now because they're just so much cheaper. Some of them have these huge piles of cash that they're earning money. And we like that. We like knowing that they can expand when they see opportunities, that they can pay us our dividend, and that their business is doing well and it's generating cash to pay us, right?
Yeah.
So in this equity slice, we like the international stocks, individual stocks, and we like business development companies, right?
Mm-hmm.
And a lot of people probably haven't heard of business development companies, but these are companies that Congress allowed to come into existence in the 80s. And basically they said, we're going to give you a tax break. And what we want in return for that is we want you to pay a minimum of 90% of your earnings to the stockholders. And these are more retail oriented. The big institutions and things are not typically investing in these. They like them as far as they like the model, and they're trying to get more involved in the model of them. And it basically what they do is they lend to a lot of good companies that banks won't lend to.
Right.
But this is more of a retail oriented thing. So there can be some really good opportunities because you don't have analysts just dedicated to studying these things like you do with typical equities.
Cool.
And right. So there's more price discovery, which we like and our clients like a lot. And these things are when you talk about that massive income, these things are paying between, 8 and 14%. And so when you build this into the diversified portfolio, it can add some real nice passive income. And that's when you're talking about the massive income from a show a couple of weeks ago. These are one of the things that's in there that you don't need a huge percent of your portfolio, and it gives you protection from interest rates rising at the same time. So you could see how these different buckets are able to not only generate income, but protect you from different types of environments and get some of that non-correlated things going on. So you have cash, you have money available to participate in the opportunities that present themselves.
Nice. Some sweet stuff. And you mentioned those BDCs, paying 8 to maybe 14% somewhere in that vicinity. And, for our listening audience, we don't put everything into there, right? For diversification, for the very reason we're talking about. We use some of those, but we don't put too much in there. And you need
to be very careful with those because there's some good ones that have outperformed, U.S. markets, and there's some really bad ones that just incinerate, people's capital.
And we have that one client whose spouse, buys those because they see that, well, they're paying a high dividend, so I'm going to buy it, but they're junk. and he ends up losing his money from that standpoint. So you have to be careful. This is not a try it, do this at home kind of thing. This is not do it yourself, guys. This is don't try this at home. And we're just trying to help you understand how to be able to have a forever portfolio on financial strategies with Daniel Agemy, because people don't know what people don't know. And today we'd like to give you a book so that you can know some of those things you don't know. That's written by our friend Jeff Slaw, called Turning Financial Planning Right Side Up. And you can have this book. It's going to be able to help you be able to understand these things we're talking about today, and even some other things besides, to be able to round out, and so that you can be a smart, educated retiree. We believe that a educated retiree is a happy and stress-free retiree. When we're trying to help educate you, and whether you're 5 years before retirement, 10 years before retirement, in retirement, we'd consider you a retiree. So you can have that book for free by calling us at 800-725-7616 for your free copy. Turning Financial Planning Right Side Up, 800-725-7616 for the next 5 first-time callers at 800-725-7616. Remember, an educated retiree is a happy and stress-free retiree. Join us next week.